Hello, in this lecture we're going to be talking about supply. So we'll start off with our familiar supply and demand graph where we have the upward sloping supply, the downward sloping demand. We are at equilibrium. We took a look at demand last time and we were going to concentrate on supply at this time. So we're going to take this apart piece by piece, now concentrating on the supply side. What does supply mean? Supply represents the idea of what sellers are willing to supply at different prices. So if we have our pizza here, we're talking about how much pizza are sellers willing to provide at different prices. If we take a look at our axes, at our graph, we have the y-axis or the vertical axis being price, and then we have the horizontal or x-axis, that being quantity. So quantity in this case being pizzas, price being up here. These are the only two factors that we will be talking about when we are looking at the relationship of the supply curve. So anything other than price and quantity is going to have some other effect. We won't be moving along the supply curve. In that case, we will be shifting the supply curve under those types of conditions, which we'll talk about at a later time. The concept of an upward sloping supply curve is what we want to take a look at this point. We don't want to worry about how steep the slope is here. We just want to justify that upward slope. And we could do that. We could say that if we're at P1 here, point P1, we would then have quantity Q. That's how much sellers would be willing to provide in terms of pizza in this case at a price of P. So if they can sell them for a price of P, they would then have this quantity. It's important to note that we could be talking about an individual seller or we could be talking about a market. So we could have an individual pizza seller and talk about that individual supply curve. We could have a market and talk of pizza and talk about that supply curve. In any case, in either case, if the price happened to go up from P1 to P2 and we draw that over to the supply curve and then down to the quantity, we can see that the quantity would then go up. And this should make intuitive sense. If the price goes up, suppliers would be willing to produce more. Now, a point here is that you might be thinking, well, if the price goes up, what does that mean? The pizza place can charge whatever they want. They can increase the price anytime. And when we get to the concept of equilibrium within markets, we'll see that the concept here is that the supplier is a price taker, meaning the market will set the price, and we'll talk about how that happens. But for purposes of this graph, we want to keep in mind that when we talk about P1 and P2, we're trying to say that it's perfect competition, and therefore the market will set the price, and the individual seller will then have to sell at the market price, basically if they want to stay in business. Therefore, we're saying that the P1 goes up to P2 is out of the individual market or individual seller's control in this case. If the price goes up and we think of it as an individual company selling pizza, and the price then goes up, we can think that that individual company would want to sell more pizza and increase the price, the profit at that point. We can also think of it as if the price goes up, then other people would see, in terms of the entire market, other people would see that there's money to be made, and other firms might then enter the pizza market at that point. That's the justification for why price goes up and quantity would then go up. Obviously, if price went down, the reverse would happen. We'd have the reverse trend. Graphically, in this format, we can have a chart that would list out the supply curve. For example, if we're talking about tablets in this case, and we say the price is $50, at 50, the quantity we're saying is 0. At $75, if the price goes up, the quantity is 75. So at 75, we are over here and we are up to 15. At 100, if the price goes up to 100, we're at 100. The supply is upward sloping. We're now at 30. At 125, we are now at 45 that will be supplied in terms of the tablets. 150 over here, we're now at 60 that will be supplied in terms of quantity. And 175, the market would be then willing to supply 75. So we can see graphically and in the chart format the upward sloping supply curve. Next concept we want to point out is the producer surplus. The idea of the producer surplus being the gain from the exchange, the value that the producer is receiving from the exchange. Again, we can think of this as an individual firm or the market for pizza as a whole. We can say that if an individual was willing to pay down here, that's how much they were willing to sell the pizza for, or produce the pizza for, and we have a market price up here. The difference between those two is the producer surplus. If we think about a market, we'd say that there's a few firms here that are still willing to provide pizza at this low price, even though the price is up here. To them, that's the surplus to them. Then if we work up the supply curve, we could say from an individual, if the individual is willing to provide the second piece at this point, and they're able to charge this price, the difference is going to be the surplus. If we think about a market, we might have a few more firms that are willing to provide pizza at this price, the slightly higher price than this price. And if the market price is up here, then the difference for those firms is going to be the consumer or the producer surplus. And we can see that the area of this triangle below price and above the supply curve, the area of that triangle will be the producer surplus, which we can then measure with the area of a triangle being base times height divided by 2 or base times height times 1/2. So that's going to be the producer surplus, the value to the producer from this exchange from this market.